Let's say one day you strike 4D or you receive $1 million in inheritance. How should you use the money? Should you quit your job and go travel around the world? Or should you buy a new condo? Or maybe should you all in into a certain company that makes AI chips, Nvidia? While suddenly receiving a large amount of money is a super good thing, it can also be disastrous, especially if you don't know how to manage the money. That's why in this video, I'll be going through what I would do if I receive $1 million in cash, which I did not, just in case you are wondering. But before I start, do join my 9,000 members Telegram chat group to discuss or ask any questions that you might have. Alright, before I would even think of spending the money, the very first thing to do is to take a breath and calm down.
Everybody stay calm! What's the procedure, everyone? What's the procedure? Stay calm!
Because I don't want to get a heart attack upon hearing I receive a life-changing amount of money. Besides that, I will also avoid telling my friends, my relatives, and online strangers like you guys that I have this large amount of money. Instead, I will only choose to tell the people that needs to know this, because the last thing you want is for your aunties, uncles, and internet strangers fighting over your wealth, which by the way, is a pretty common thing. Okay, now that we have achieved a Zen mindset, here's how I will allocate the money. First up, I will pay off any high interest debt. And by that, I mean any debt that has at least 4.5% interest or more, such as personal loans, student loans, credit card debt, and any Along loans that you have. That's because by paying off these high interest debts as early as possible, it's as though I'm earning a guaranteed return of at least 4.5%. What ah? But here's a question. Is it a good idea to also use the money to pay off low interest debts like HDB loans or even bank mortgage loans? Personally, I won't do that. That's because both HDB loans and bank loans are now below 3%. So it's better to just invest the money into risk-free investments like SSB or T-bills to earn at least 3% interest and use the interest to pay off the loans. Now, once I've cleared off all my high interest debts, assuming I've any money left, the next step is to split the rest of the money into short, mid, and long-term savings. That's because depending on where I park my money, they will have different risks and different returns. So it's super important to allocate the money accordingly. So let's talk about the short-term savings first. These are the money that I need to spend today, next week, or next month. That's why I can only park them in places like high interest savings or money market funds, where I can access the money immediately while having very little to no risk. For this, I will first set up an emergency fund. This is to prepare for any unexpected expenses that may pop up along the way, such as accidentally kena accident or job loss. The recommendation is to allocate 6 months to 1 year of living expenses as my emergency fund. So, for example, if I spend $2,000 every month, I will need to set aside $12,000 to $24,000 as my emergency fund. Besides that, I will also set aside another 1 to 2 months worth of living expenses as my short-term savings. This is so that I can easily withdraw the money from the bank whenever I need to. So, where are the best places to park my short-term savings? Right now, the two accounts that give the highest interest are the UOB One account and the OCBC 360 account, as they are giving around 3+% interest if you can fulfill their requirements. Otherwise, if I don't have a fixed money income, a simple no-frills account would be Maribank, which gives 2.7% interest, or even cash management accounts, which invest my money in bond funds and money market funds to give a return of around 3 to even 4%. Though it comes with additional risk, so it's not for everyone, yeah? But for more info, do check out my video here. Next, for money that I do not need now, but probably need 1 to 10 years later, those will be my mid-term savings, such as my holiday trip next year, a house 5 years later, renovations, and so on. While it's tempting to invest all this money into the stock market to try and get a higher return, it's also possible that the market may suddenly boom, crash and I end up losing my money instead. For example, this study found that if my investment period is 10 years or less, there's a chance that I might end up with negative returns. In that case, it's better to park my mid-term savings in Singapore savings bonds to lock in a yield of around 3+% return for the next 10 years. The benefit of SSB is that the funds are rather liquid, as I'm able to redeem and get back my money by next month, which could be useful if I suddenly need the money, or if I wish to recycle the capital into another SSB with a higher return. Plus, since the interest is paid out every 6 months, I could also buy 6 SSBs over the next 6 months to create a bond ladder which will give me cash payouts every single month. So that's nice. Though, just think that you can only invest up to $200,000 worth of SSB. So that's still quite limited. Good news, Tiger Brokers has just launched their Cash Boost account with CDP linkage, which means you can now sell your CDP securities at a low cost. To do that, simply switch over to the Cash Boost account by going to the Portfolio tab, tap on the Account Switch button on the top left, then select Cash Boost account. If you have not opened the Cash Boost account, you will need to open it first. Then head over to the Portfolio tab, tap on Total Buy Limit, then link CDP account now. Once you have successfully linked your CDP account, you will now be able to sell your SGS counters. By choosing on the SGS counters that you want to sell, tap on Trade, Sell, then select CDP Sell to sell. So simple! This feature is very useful as Tiger Brokers charges a commission fee as low as $5 compared to traditional CDP link brokers of $25, saving you a ton of fees. On top of this good news, in celebration of Singapore's 59th birthday, you can now trade SGS listed stocks with zero commission. With Tiger Brokers' latest welcome promotion, you will stand to receive rewards of up to $1,006 depending on which task you can fulfill. For example, if you can make a first deposit and cumulative net deposit of 1000 SGD during the promotional period, you will get a 6.8% per annum interest boost voucher for 60 days, plus a 10 USD voucher package. Otherwise, if you can make a first deposit and cumulative net deposit of 100,000 SGD or more during the promotional period, you will get a 6.8% per annum interest boost voucher for 60 days, plus a 100 US dollars package. So if you are interested, you can sign up to Tiger Brokers using my link down below. With that being said, let's get back to the video. Besides that, another trick that I can do is to move my money around various banks or brokers to take advantage of their promotions. For example, the Standard Chartered Bonus Saver promotion, which gives up to $163 worth of cash. The UOB Nation of Savers promo, which awards up to $1,100 cash credit. Or the HSBC EGA monthly promo, which gives up to 4+% interest. Now, once I've set aside both my short-term and mid-term savings, whatever leftover money is my long-term savings. These are the money that I don't need in the near to mid-term, but only need during retirement. And the best way to grow the money is to invest it. Now, when many people hear the word invest, they'll be like, "Aiyah, so risky, invest can lose money one." But you know what's riskier? It's not having enough money to retire, despite having worked your entire life. But here's the good news, because there's a super easy way to invest, and that's by investing into something called exchange traded funds or ETFs, which is just a basket of stocks. That way, you automatically get diversification while investing in the best stocks and avoid having to spend time researching individual companies. So that's nice. Currently, the best companies in the world are in the US, like your Google, Apple, Amazon, Nvidia, and so on. So one way you can invest in them is by investing in the S&P 500 ETF, which hosts the largest 500 companies in the US. For most people, the S&P 500 is already good enough. But one issue with that is that there's geopolitical risk, where if the US booms for some reason, my investments will liao. So one way to diversify is to go for the all-world ETF, like VWRA, where I will get to not only invest in the US, but also across many different countries, such as Japan, UK, China, France, and so on. But here's a question. Would it make sense to invest in both the S&P 500 ETF and the all-world ETF? Yes, it would make sense, because this just means you are adding on a little more weight to the US, which is perfectly fine. In fact, this is called the Lazy 2-Fund Portfolio, which is a popular choice among many investors. This portfolio is very versatile, as I'm able to change the allocation however I like, or even add in more holdings if I want to. For example, if I wish to receive some passive income, I can just add in ETFs like the STI ETF or the Lion Philippe S-REIT ETF, or even individual Singapore dividend stocks to get anywhere between 3% to even 6+% dividend yields. This will also help to reduce the foreign exchange risk, since both the S&P 500 and the all-world ETF are in US dollar and the Singapore stocks are in SGD. Okay, here's another question. given that the market is at an all-time high now, is it better to wait for a crash before you invest, or invest all the money now and ride the wave up, or just slowly DCA into the market? Trying to wait for a crash now is definitely a bad strategy, as all-time highs typically lead to more all-time highs. So by waiting, you risk buying at a much higher price. Plus, studies have shown that there's not much difference between investing at all-time highs versus investing at any other periods. Okay, then what about investing all my money now versus dollar cost averaging into the stock market? According to a study, lump sum investing actually beats DCA 68% of the time. That's because the market tends to go up over time. So it would definitely make sense to invest all your money now and ride the wave up. However, the same study also found that even when lump sum investing beats DCA, the difference in returns is actually very little. So it doesn't matter whether you lump sum or DCA, as both methods work equally well. In that case, DCA would be a better strategy, since it will give you a better peace of mind, because you won't be risking all your money at one go and pray that the market will only go up from here. But if you want a more systematic way to invest, the Money Guide recommended that if the total amount to invest is less than 10% of the portfolio, you should just lump sum. And if it's 10 to 15% of the portfolio, I should DCA across 5 months. And for every 5% increase in the percentage, I can just increase the number of months to DCA all the way to a maximum of 12 months. So that is how I would invest my long-term savings. Now, perhaps the biggest takeaway here is to avoid lifestyle inflation. That's because while it's tempting to want to improve my standard of living when I have more money, like buying new cars, buying a bigger house, if I end up overspending my money, I would eventually end up with nothing. But with that being said, it is still important to enjoy the money a little bit, because life would be pretty meaningless if we can't even spend our money and live a little. For example, you can still spend a bit of money at fancy restaurants every once in a while and go for holiday trips every now and then. As long as we spend below our means and the spend is sustainable, it is totally fine to spend it. Or if this expense can be paid via passive income from my investments, that would be even better. Anyway, this is a quick video on how I would manage the $1 million if I had it, which I don't, by the way. But it is always nice to dream a bit, yeah? Anyway, remember to like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.